Good morning, ladies and gentlemen. Well, a week of quite odd price action, really, and we will talk about wars and what normally happens during preparation for wars. Model score very much unchanged on the week, down a few points, but absolutely nothing significant. What was significant is if we look on the price action on Friday, we see a very pronounced risk off in terms of gold going up against every other risk off asset. And the other thing that is very odd to me is that still the technology sector is one of the most stable sectors. Normally, that is the one that actually is one of the most volatile, and it's being one of the most stable. So we shall see what happens, but these are the things that the model is highlighting as odd or significant. And let's now try and put it all together and see what the markets normally do and what they're actually trading at the moment, because it's not what you think they're trading. The bond market actually had a very quiet week. This is the 2 year note, daily chart of the 2 year note, and basically closed the week exactly where it opened it. We had a little bit of flight to quality on Monday, and then we spent the rest of the week going back and closing more or less exactly where we closed the Friday before. So it really says no flight to safety, but also it might be indicative of the fact that we did get hot numbers in both PPI and CPI. To me, the 2 year note is saying the Fed is stuck. The Fed is very unlikely to hike given the data that we've had. And let's face it, from now on until the Fed meeting, we have nothing but second rate data, nothing that is likely to make the Fed change its mind. They are leaning towards no action and letting the long end do the work for them. And the 2 year note, as a result, is just meandering in a 25 basis point range, up, down, and that is all there is to it. The funny action was actually in the 10s and 30s, which on the week came off slightly, which is unusual because normally in periods where we are preparing for war, you get a steepening yield curve as people, sort of invest their money in the very short end in the flight to safety. But even in the 10s and 30s, we're not breaking and sustaining any levels that would be concerning. Let's go to 30s, basically got to exactly where I thought we'd get, which is whatever the support of the middle Bollinger is, and then bounced and stayed in that area. It's just not giving us any indication that this market wants to do anything but go sideways. And if we look at the yield curve, 2s, 10s, well, we flattened. Normally we would expect some sort of a steepening, but we flattened, and that is probably more of a factor of the numbers and the fact that we had steepened so much, so we flattened a little bit. I would expect the resistance to be at this level, 47 in the 2s, 10s, and in the 5s, 30s, I'd also expect this area to be very hard to break around 08. And if we do, well, we go to zero, but that's about as far as we go. I think the natural tendency over time is going to be for more steepening. That's all that the bond market is telling me, and it's not a lot. And really, I can't tell you any more than I can see and the price action tells me. So I think this is not a time to be trading the individual 10 years nor the yield curve. I don't think either is going to give you a very good read. What is giving us a good read is what the spreads between countries are doing. Before we look at the country spreads, let's have a look at what the German market is doing and its yield curve. Twos, the Schatz very much like the twos in the US, doing absolutely nothing significant, meandering in this area of 20, 25 basis points, saying the same thing as the 2-year note, i.e. the ECB probably does not want to act again and probably just is happy to wait and see what the data finally says. If we look at the Bund, basically spent the week doing not very much. Quick move to risk off and then nothing. Basically, it stayed in a very tight range. But what is significant is that unlike the US, it's doing it below the center line of the Bollinger Bands. And that's going to give you a clue as to what I'm going to talk about next. And the same for the 30s. So if we have a look at something like 2s, 10s in Germany, they are actually flattening more and faster than 2s, 10s in the US. But the big stuff is happening in Italy. And Italy, if you contrast 10s in Italy, it's a completely different picture from the picture of the 10s in Germany. It is staying above a very steeply positively sloped middle Bollinger Band. And let's have a look at where that actually takes us in time. I think that it traded long enough between this 485 and 365 area. It traded there for the best part of over a year, and it's now breaking out. And when it breaks out, it tends to go to this kind of level first, and if it breaks it, then it goes up a lot. And you can see this area here. So that is what it tends to do, and that is, I think, the fundamental view of what it will do going forward. So now let's have a look at the spread. Here we go. Italy against Germany. I don't think this last part happened. I never saw it. The market closed at 1. Maybe there was a little bit of price action after, but basically let's say that it closed at 203, which is exactly the level I traded on Friday to take some risk off. To me, this still says that its target is at least 216, possibly 227, and possibly all the way up here towards 260. To me, the market is trading these spreads, not so much anything else. And if we look at the butterfly between Italy, Germany, and the US, even if we closed here and didn't have the last 4 or 5 basis points, to me it's quite obvious that it's opening up with time. Every time it rallies anywhere near the previous lows, it gets sold again. And this is the kind of market that is likely at some stage to be very volatile and even go down to 428. So that all fits in with what I'm thinking the market is trading, and that is the supply of bonds and the fact that the risk off is most significant in the markets which have the lowest supply, which makes sense. If there's less stuff on offer, any kind of risk off can make it go further to the downside in yield and upside in price. While the opposite is true for markets like the US, where supply is still plentiful. We saw the auctions last week, and who's got money in it, having bought the auctions? The market keeps on trading at those levels or worse. There's no one that's getting rich buying the US auctions, and they are just scheduled and scheduled. We have very little next week, actually, just some 20s and some tips. But after that, the week after, we get another 130 yards, and then we finally get the QRA on November the 1st. I would argue that until November the 1st, when we know what Janet Yellen has in store for us, these are the markets you want to trade. You want to trade this butterfly, and you want to trade the spread between Germany and Italy, because those are the markets that are most likely to move, especially if there's risk off, right? Because in risk off, as I said, it's about what's on offer, what can I buy? And, if you buy the US, there's always another offer behind it because, they're all full from the auctions. While in Germany, it's completely a different story. So I'm thinking that the spreads between these countries are the things that are the most reliably going to make you money over the course of the next 2 weeks. So now let's have a look at the spreads between the US and Germany. This is the twos, and it looks to me like, this might go sideways and probably has the least potential, but it still looks like it's going to push upwards. Fives, to me, it's absolutely certain that it trades 208. Tens, you remember when I was saying down here, this is going to go? Well, it's gone. Probably, where's it going to go? It might come back a little bit, but it's definitely going to test this 200 area to me. And the one that's most interesting is the 30s, because I think that any dip down here towards 178, 180, and it's going to go to at least 192, if not 201. That is my reasoned target. So another 16 basis points from where we are towards this target of 201. And that's going to be a very difficult level to break sustainably. I think it makes sense actually not to have anything there, but any dip down towards 175, I'm a buyer, and I'll buy a little bit before that, because I definitely think that before all this is over, it trades this 201 area. The risk reward in DXY is still non-existent as far as I'm concerned. You can't be short of it because, anything can happen in the Middle East and you'll be 100 Euro USD ticks offside in minutes, and therefore you can't be short of it. But the risk reward of being long here is just, to me, not great. Unless it starts breaking through this 107.35 area, in which case you can do a quick Momo trade. But it just doesn't feel right to me to go all in long dollars at the moment. The price action on the week, slightly up, but really not that much given what is going on, which to me is a sign that the market is tired. And if we look at Euro USD, it nearly got to these levels that I wanted to short, and that is, it's a market which wants to frustrate you. So what it might do is go and bust through these levels, get everyone long dollars, and then come back. So to me, the risk reward is still non-existent. It's not something that I think is preferable to playing the spread between Germany and the US, which to me is a much safer bet than playing the dollar. So that's the way I feel. I'm not going to change my mind. I'm not going to play dollars unless I see decent levels. And to me, decent levels are here, just above the 106, 30, 50 level. That to me is a decent risk reward area. Everything else, well, you can do some put spreads. They're not going to hurt very much, but that's about it. Before we have a look at gold, let's have a look at this chart, which is basically a real 10-year note. We are about as high in reals as we've been for 2 decades. Now, were they higher before, during the 80s and 90s? Yes, but I would argue that those were different periods when growth could be a lot higher than it can be now. I might be wrong about that, but that's what I think, and I'm not going to change my mind because of a few squiggly lines over a very short time frame. So, we got up into the 250s, I got long, and now my question is, why would I hold gold at 0 real when I can hold 10-year notes at 2.5 real? To me, that is the question that anybody who owns assets has to ask themselves. What advantage does gold bring me over tips? And don't forget, we have a tip auction this week, and I will participate. I will try and buy some 5-year tips for my investment account because I see no reason not to. So now let's have a look at the chart of gold, which on Friday just went ballistic. And really, I think that the reason why it went ballistic is because nobody wanted to be short over the weekend. And now, if something happens over the weekend, and I don't know, this is Sunday that I'm recording this very early, something could be happening, something could happen tonight. Who the hell knows? But where's it going to open? Well, it could open a couple of percentage points higher, but it's going down. I just can't see why anybody sane would hold gold as opposed to tips. Not for the long term. In the short term, over the course of a day or a few hours, anything can happen. But longer term, I think the odds are stacked against gold at these levels, and I just don't see why that would change. Now, for anybody who thinks, oh, gold is going to go up forever because there's war in the Middle East, I just don't see, can things get worse in the Middle East? Can we start bombing Iran, or Iran starts bombing Israel? And will gold spike? Absolutely. But to me, the spike is the sell. So what actually happened last week? Well, the week before, if we have a look at this chart, you will see that we were outside all the weekly Bollinger Bands. Yes, we were outside of everything down here, and a bounce back to the weekly 200-day moving average, and all these moving averages which are still far above in the high 1900s, is really not surprising. It's a technical reaction, right? Let's have a look on the daily where we are. This is the 200-day, which is only now starting to reverse. Can we go up to it? 1980s? Absolutely. But do I think it's a buy there? No, I think it's a sell. And I don't think it's a sell because of the technicals in gold. I think it's a sell because it brings you no yield as opposed to 2.5% real. Now, what would you need to believe gold more than tips? Well, you'd have to believe that the US is going to cheat and not give you CPI. But, how likely is that? Why would they do that? And secondly, you have to believe that possibly the US is going to default. And I don't know what else you could believe. I think it's a lot easier for some Middle Eastern potentate to put their money into tips than buy gold and carry it with them. It just doesn't make any sense in terms of convenience or anything to hold gold over the medium term unless you think the end of the world is coming. Well, good luck with that one. DBC is really not giving you any clues. It just keeps on going up and down, which is normal for an asset which is being buffeted by fears of war, because the supply disruptions could be significant. We just don't know, but they certainly could be significant. And therefore, to me, it's actually surprising that oil, which is the one that could be worst affected, is actually doing not a lot. So what happened last week? Well, we opened up on the spike, we came back down on Friday, nobody wanted to be short, so it went up basically back to where it closed on Monday. Okay, is that particularly bullish price action? No. Should this chart be bullish? I guess it should. Because if we look at what happened in previous times when we traded a potential war, is that the market anticipated during the build-up higher oil prices, higher gold prices, lower equity prices, higher bond prices for many weeks and months. And then just before or just the moment when the bullets started flying, there was a massive risk-on move. Because everyone knows that the US is going to absolutely crush the living daylights out of anybody who stands in their way. That is not in doubt. The US can destroy any country in the world in about 48 hours. So, we know the outcome of the fight. So normally when war is about to break out, what happens is that there is a period of risk off during the build up to it. And then as soon as the bullets start flying, risk on. Massive risk on. And I can tell you that my first reaction, the moment the Iranians start doing something stupid, if they do something stupid, is to look for levels to buy anything that is a risk-on asset rather than participate in the risk-off. I'll be looking to sell all the spikes in gold, in oil and stuff like that, because the US is going to crush them to nothing. The one chart that is giving me a bit of a worry, and I don't know what to make of it yet, is gold against copper. Now you can see that we've been in a range basically, for months since, what is this? This would be sometime in, what was this, 7th, so July, we've been in a 3-4 month range here, and now we're breaking out. Is it significant yet? I don't know. I know a lot of people poo-poo gold against copper, but it anticipates by a lot. So it's not a signal that you can use on a daily basis or even a monthly basis. But it predicted what was going to happen to bonds many, many months before it did, and now it's predicting that we are going to go in a sustained period of risk off. Now, Will it happen? I just don't know. I think it's a warning signal, and I'm undecided as to how to interpret it at the moment. But as I said earlier, normally before a war starts, and I have no idea whether a war will start, the market goes into periods of risk off which last for months. Go and have a look at the price action for the first Gulf War and the second Gulf War. Basically, you had months of preparation for it, during which it was risk off. And as soon as the bullets started flying, massive risk on. So could we be in for something like that? And that is what this chart of gold copper is predicting. Could be. It's just that I can't see with all this supply in bonds that we're going to get sustained rallies in bonds for for a long way, as it were, or a long time. But it could happen. I mean, risk off swamps everything. So even if Janet Yellen decides to issue another 200 billion worth of bonds in Q1 and tells us on November the 1st, and even if the data continues to be hot in the US, and even if CPI accelerates and all these things happen, risk off absolutely swamps everything, because it doesn't need to make sense. People just put their money where they think they're going to lose least, and that tends to be treasuries. To me, that actually is, at the moment, is tips, because at 2.5%, you are not going to lose a lot there. You can lose a lot more in hours in every other market, but never mind. I just wanted you to see this chart of gold against copper, which is saying that we could be getting some risk off, but there we are. In equities, I think we're getting to the who the hell knows stage. And this clean chart is actually the best I've got, because every time it's got to this 43.84 level, it just touched it and backed off. I think Friday was quite significant insofar as we tried to get back up there, couldn't, and basically closed the week more or less exactly where we closed the week before. In fact, very, very slightly higher. I think that every rally here is going to get sold, and at some stage we trade back down to this 42.55 area, where I would suggest covering. I mean, any kind of a rally here, put spreads, this being the lower strike, the upper strike being, whatever the at the money is, I would suggest around the 43.40 area. If you see it, you sell it, because I think over the course of the week it tests that level, and you're out, and then you're waiting. I think it's extremely unlikely that with the situation that we have, and with the fact that we have earnings starting to gather pace, the fact that the companies are in the blackout period and they can't buy back their own shares, I think it's extremely unlikely that SPX is the one that can start breaking higher. I think it's more likely that it trades at support, but I just don't see that support is going to get broken. Why don't I see support being broken? Because earnings are going to be good. So unless there is some really bad piece of news that comes out and knocks the market for six, I just can't see that we are in a bear market for equities at the moment. Let's very quickly have a look at a weekly chart of IWM, because it's quite interesting that it keeps on bouncing off the Bollinger Bands, trades down to the weekly Bollinger Bands, bounces a little bit, comes back down. But slowly, it's turning this weekly moving average, the long ones. See, every time we get up here, it's resistance. So this is telling me, I just don't see that equities as an asset class are a big sell right now. And that is because the only thing that can lead equity indices down are the Magnificent Seven, because everything else is as low as you can possibly get it to go and not bounce viciously. Can you go down another percent, another 2, another 3? Yes, but we're not talking about 5%, 10%. I think this market is more likely to be stable at these levels and slowly turn these moving averages if we are going to go down. But that tells me that we are stable for quite some time. And even if the weakest part, which is the small caps, is unlikely to go down very much, then I can't see very much downside in SPX. I think it's literally as simple as that. SPX is not going to be the weakest index until and unless you start getting the big weakness from the big names. And I think that the likelihood of tech going down significantly over the course of the next 2-3 weeks before earnings is not great. So let's have a look at NQ and try to triangulate as much as we can. It really did nothing last week. I mean, they tried to get everything down on Monday, and they couldn't. The market just rallied straight in their face. And then on Friday, there was a little bit of risk off because nobody wanted to hold positions into the weekend. Is that normal? Absolutely. But is this particularly bearish? I just don't see it. We're just holding levels extremely well. We've proven that 15,300 odd is very important. We've proven that 14,920 is important. Could we go all the way down to here? Yes, without a doubt. And that is the bit that I can triangulate with the SPX going down to the levels that I showed you. But I think from there it bounces, and it bounces hard again. I just don't think anybody wants to be short of Apple or Microsoft or Nvidia or anything like that going into earnings. And let's have a look at vol. I keep on saying that to me this 2060 level is absolutely key. I will not get bearish equities until we start getting daily closes and preferably a weekly close above 2060. I think that unless we do that, the potential for getting down and staying down and accelerating down in equities is very low. To me, that is the most important things I'll be watching as far as equity trading is concerned. I don't want to sell equities at the lows that I showed you. But if I see volatility staying up above 2060, that is telling me that there is some danger and there is some mileage in buying put spreads. Until that happens, I just don't see it. I've updated all the levels that needed updating, and my conclusion after having looked at everything in all the charts is that we stick to our knitting. We stick to the stuff that makes fundamental sense and technical sense. And when the technicals and the fundamentals marry, that is where you want to start trading for real. And that is the stuff that I like. I like the Bund BTP. I like the butterfly with the tens. And that is all I think at the moment in this time of uncertainty, when you don't know what the next headline will be or when it'll come or what the positioning is that it's going to blow up. because let's face it, that is what's happening. People's positions are getting blown up, and that is why things like gold move as much as they do in a day, because a lot of people were short, I guess. And when that happens, you want to stick to your knitting and the fundamentals. And when the fundamentals and the technicals marry, that is the thing that you want to trade. To me, that is Bund BTP and the butterfly between the Bunds and US with the BTP. And that is all you want to do. And as I said, to me, 2060 for equities is absolutely key. I don't really want to stay short in equities beyond support levels unless this starts giving way. Thank you very much indeed, and have a lovely weekend.